Everyone that has ever looked into how contemporary banks work knows that they don't. Quite simply put, there is currently an international cabal backed by every state due to economic necessity. This international cabal has provoked just reactions from people both on the left and on the right, but it has led to a denouncement of banking in general. Here I will argue for a very specific kind of banking and demonstrate how the current banking system is completely unsustainable. Governments create debt out of nothing. They don't really owe this debt to anyone other than other governments through international banking schemes. At this point in time, almost every government is operating far above its means. It is easier to resist tax collection than the creation of debt, which has to be paid by future taxes. This means that the government's only fiscal responsibility is to the banking cabal and the central banks within the governments. It's true that a lot of government debt is nominally owed to private individuals and companies. However, each individual and company has very limited input when it comes to the debt. Thus, these people are liabilities that can be dealt with by state policy. A large portion of the bonds and liabilities created by the government are taken care of by the World Bank and the International Monetary Fund, both of which ensure that states and individuals have constant debt. These banks constantly ensure that the socialist Keynesian policy can continue to be built under capitalist terms. Both of these organizations operate under pretenses that may seem virtuous. They are supposedly in the business of reducing poverty, increasing stability, and conforming to every other progressive platitude. These utopian policies are just a narrow shell to cover up the real purpose of these institutions, which is to continually enforce the status quo and to ensure the de facto poverty of all nations of the world. To do this, they accrue money from developed nations and give that money to the nations that are not suited for handling such money. Furthermore, they do so explicitly to reach leftist goals. To add to this burden, they maintain floating fiat currencies and ensure that each country continues loaning their money in a complex structure that is completely unsustainable at every level. To increase the burden more, there is a relatively new European Monetary Fund, which takes on the same scheme in the scope of Europe. All of these banks and institutions serve no other purpose than to keep the nations of the world under one global control and to override whatever market decisions or local political decisions people would have made. These serve as immense agencies of destruction. In modern international trade, those who negotiate trade are not the people who do trade, but rather the governments who set agreements for the trade. Since trade is negotiated by the governments, there will always be a deficit in trade. One party will import more than the other party. Thus, one party must borrow enough money to continue importing more than it produces. Without the government in the way, this would not happen, as the people outside the government would not care about aggregates and cannot spend far beyond their means. They have to eventually pay off their debts, so there can be no actual deficits in trade as a long-term issue. However, when there are states handling trade, there are deficits. Whenever there are deficits, there is money that has to be borrowed. Whenever money has to be borrowed, the banks are there to facilitate that borrowing of money. Since there are always deficits and there are always international banks, there are always great profits to be made for those banks by simply involving themselves in the process of government bonds and other borrowing. There are perpetual discrepancies in trade between countries, and these are not fixed by the individuals who do trade and thus are seen as a problem. Unsustainable trade can be only facilitated by relentless borrowing, so eventually the bank gets its share of the spoils. This is true no matter which particular nation has a deficit to another nation. It doesn't matter what form of disequilibrium is present. The international banks will always get their cut as long as there are these issues within international trade. This means that there is a perpetual, reliable stream of income for the banks. The only thing they have to ensure is that the governments create discrepancies and subsequently create debts that need to be eventually paid off, at least on paper. These banks can then use debt as collateral to create even more debt. This brings us to the organized form of debt slavery in the 21st century. Many market-minded people are appalled by the notion that willing people accumulate debt are somehow slaves. However, this is not plain socialist conjecture. Banks intentionally misrepresent information to get people to acquire liabilities that are not guaranteed to provide them with any profit. These liabilities still guarantee that the banks get their maintenance fees. This is purposive and perpetual fraudulence. Furthermore, the system of credit, which punishes people no matter how wisely they handle their money, accumulates perpetual interest for the banks. This is because it is very easy to fool people into overspending if it is made routine. And these are not the voluntary, conscious decisions made by people, but rather institutions designed to benefit the banks at the expense of the people. These banks and institutions are further reinforced by the state that secures that they cannot be prosecuted for their unreliable schemes or their misrepresentations or unjust fees. Furthermore, due to state legislation, banks have a special status as moneylenders, changers, and holders. Thus, the banks will receive any additional protections the state wants to institute, and the banks have their fair share of charging people unjustly. It's a common occurrence that a bank creates debt intentionally in order to keep the interest of the debt present as a continuous source of income so that the people who have the debt will always be under the control of the bank. This may be achieved via massive overdraft fees caused by the upkeep fees, or they may be caused by a person not having enough money, resulting in the bank deciding that the person must pay for the privilege of having to hold their money in a bank in order to do business and pay tax. The great schemes and machinations of the banks are always present to keep people within their grasp and to never let anyone handle their money independently of the bank. The state helps secure that this always happens and that people have no choice by creating a universal standard of money. After doing so, the state monopolizes the industry of money by only letting certain banks handle money and using legislation to destroy any competitive banking. Without a system of banking that relies on the state mandate, predatory banks could never manage to charge fees upon fees from people that don't have the money and are economically forced to use the bank. Furthermore, the state expects the banks to increase state power and, as such, is willing to provide them subsidy. This allows the state to further control and manipulate the people within its territory. The state accomplishes its goal of expansion when people are under the control of the banks, which are under the control of the state. The state also relies on banks to inflate the currency more than the state itself can. When the central bank prints money, the state can only distribute the money to select groups and cannot ensure that this unfunded liability will be at the basis of the economy as a whole. The state accomplishes its goals better if it lets banks have completely digital and fiat money in exchange for some token guarantee to the Federal Reserve. Then, as the banks are not required to keep full reserves, they may convert these virtual assets into debt and loan it to another bank, creating interest out of nothing and having an additional liability in their portfolio. Thus, the digital representation of money will be a greater amount than even the printed money in the economy. From here, the other bank can lend its money out using the credit to back its other liabilities. At the end of the day, the banks manage to perpetually create more debt than there is actual money. This is because both banks use the same money to back their liabilities, even though neither bank actually has this money, and this money is used in the economic actions of a third party. The former part of the essay may seem completely compatible with leftism. We do need to acknowledge that leftists can be right about the banking system as it currently stands. Our approach to banking should not be about turning a blind eye to unethical action. Rather, it should wholly be a method of critique and instituting a market solution to a state problem. And there are plenty of people who critique banks from an anti-market perspective. They propose different solutions as they feel that banks are unethical by nature and not by circumstance. One of the most important things to defend here is the practice of interest. Whether or not the anti-capitalists favor any degree of interest usually comes down to the form of the institution that gives out the interest. One cannot pursue great projects without promising compensation beyond the simple risk inherent. The return on investment would then be in the future and have the same value as it did when it was lent. This means that if one is to undertake any project that requires a degree of investment, he must promise interest equivalent to the social time preference. The social time preference is the point of equilibrium where the valuation of time balances out with the demand for time. Of course, as we cannot actually trade time, this becomes a matter of trading future goods against present goods. To bring this to a more comprehensible level, we can take the case of persons A, B, C, D, and E. Persons D and E both want to embark on their project building different things. Both projects will take around a year to complete, and both projects have the same amount of risk. D and E both profit from other people having low valuations of time. That means that they want to have to pay back the least after they have loaned money. A, B, and C all have money to loan, however. A wants 8% interest per year, B wants 6% interest per year, and C wants 5% interest per year. Otherwise, these parties think that the return is too far in the future. They are unwilling to trade their present goods for future goods without increasing the price by those amounts. D promises that he can provide 5% interest in return for funding his project. Thus, he can only get person C to invest in his endeavor. Persons A and B are not willing to trade their present goods for a future value of only 5% of the investment. Since E also wants investors, he now promises a 6% annual return on investment, getting both B and C on board, C being more happy with his arrangement than the previous one. D decides that he can go up to 7% interest and still profit. Thus, he offers 7% interest. Both B and C would invest in D rather than E, as D promises a better deal. E cannot take his own rate higher than 6%, as he doesn't expect to profit above that. So D manages to secure the clients, and the social demonstrated time preference is 6%. A is excluded from this, as he values present goods so much that no one can offer him a good enough deal. In the real world, there are millions of actors, and all of them help determine the social time preference. This is integral to decentralized planning, as time needs to be evaluated. But we can say that interest is excessive when it does not make up for material factors or time. However, on a competitive free market, people who charge excessive interest will not be done business with. This is demonstrated in the example as person A not finding investments. We can envision a world where there is no charging interest for lending money. Because there is no interest, lending money becomes functionally gambling. Money lending will be unreliable even if it happens at all. If money is not lent, economic actors cannot achieve their goals before the time when the debt would have already been paid off. Because of that, for example, young couples could not get homes, and entrepreneurs would need to earn money by working in the established order, aging past their prime while doing so. The entire economic system would be in complete ruins. Banks are also necessary to make economic transactions easier. When people trade goods, there is an inherent degree of friction simply due to the fact that those who trade goods need to set up a physical or digital transfer of goods. Furthermore, there is an inherent friction whenever money needs to be changed to facilitate transacting or when terms need to be negotiated. Banks can greatly ease this by providing ledgers to make transporting money a non issue as they keep track of the titles to money. But how can we fix banking? We have to admit that lending money is important, and so is the reduction of transaction costs that reliable third parties produce. The solution to this is very simple. Banks cannot all be the same institution. The banks that serve to reduce transaction costs cannot be the same banks that lend money. When a person uses a bank to reduce the cost of their transactions, they want to have that money in reality and not as a figment that can be inflated to any unsustainable point. These banks are useless if the title to money becomes worthless. Thus, the banks that aim to facilitate trade must keep money in reserve and not create more money than there is. The banks that manage investments need to be completely different banks. They would obviously very closely cooperate with banks as they do now, but they would then be transferred the title of the money. That means that these agencies can decide how the money is managed, and the person who owns the money will see the gains and losses accordingly. It won't be hidden in a complicated network of debt and credit coupled with interest, but rather simply a person giving his money to another person for management. Thus, the person who is managing the money would display how much he has in store, and that amount would be a fixed sum in the economy. Since the amount of money in existence, if there was a concrete amount, would always result in zero-sum outcomes when it comes to investment, a uniform rate of return would be impossible. Investing would again be about making the right investments and not collaborating in a corrupt system. However, when money is deflationary, as it naturally is, money is an investment. Because of this, even when there are nominal losses, investment is a general increase in social wealth. Investing into money will bring a profit. Thus, even if investments result in minor losses, they will be made irrelevant by the deflation. Even though it ignores all factors of the loan market, this logic demonstrates how it's at least not just reshuffling money.